Are we getting started here?
Hello.
And hi, this is Ted Wilson from Vanguard. Can everyone hear me?
Yes, we can.
All right, perfect.
And so, yeah, because Bonds was it more or something? Bonds was not Medicare friendly? That, yeah, there was something on that. Isn't this that little Walmart neighborhood there? Yeah. Yeah, no, there was something wrong with that one. So yeah, you would need to choose. Double check that one, but somebody said in my head there was something wrong with that one. Yeah, I don't remember. It wasn't a preferred pharmacy and a drug box was a lot more. And this was close as well. Okay. Okay. And if something changes, just come in. Okay. So this is my monthly plan. This is what it's going to cost. This is for a year. For a year. It's only $7 a month. Yeah, see, that's why we ran these. That's why I do this printout like we do, because I want to see. I don't want to get to month 7 and everything. You're in the coverage gap and it's like, holy moly, what happened? Even if we went for lower plan, the drug cost. Annual comparison, but you look at this number right here, this is the annual of everything. So you're looking at $36 difference in a year. And you have a better plan if anything else gets added to it and you don't pay that one.
Hey, is everybody there? All right, good. Listen, sorry, we had a little bit of a technical glitch here. As you guys know, we've had some issues with the phones here in Woodland Hills. Everything appears to be working, so we're going to plow through this. And again, I'm very sorry for the delay, anyway, technical difficulties. So let me get moving quick so we can stay on schedule. First of all, everybody, please mute your phones. If you've got questions, though, unmute and feel free to, jump in and ask me or Ted. I want to thank, quickly Ted and Vanguard for, for doing their part of the presentation today. It's going to be great. I've seen this presentation before, and I'm really glad you're going to have a chance to see it. Value, what we do, how we create value for clients, very important subject, and I think you're going to really enjoy what Vanguard has done here. And the credibility of Vanguard's research, I think, is really good. I mean, this is a firm that has a long history of, being in the do-it-yourself game. Will tell you, they have done some really nice work showing how having an advisor creates significant value for clients in their financial planning and in their investment planning. Some quick items here. Equifax cyber breach. So back last Wednesday, a guy named Eugene Davidoff, he's the director of IT security at Lincoln Investment, sent out an email that I thought was pretty good about investor inquiries, about what should they do. I'm guessing some of you, I know that some of you have been getting requests and concerns from clients. I think there's some really good advice here, and one of the main reasons that I want to bring this to your attention is just to remind everyone, you see the word cybersecurity, and especially if it comes from Lincoln or from us, please read it. This one in particular is helpful for clients, but there are other things that you're going to see from Lincoln and from us that have to do with the way you operate and keeping your clients' information safe and secure. This issue is not going away. It's just going to get bigger and bigger and bigger. So it's something we all have to pay very close attention to. So again, it's a reason to take a quick look at Advisor Week, take a quick look at our weekly newsletter, and then if you see this kind of stuff, read it, file it away if you need to, and if you have, please let us know. The second thing I wanted to bring up has to do with annual reviews. Judy Lalinka asked me to make sure I talked about this. Every year we ask for this, and I know that a lot of people, it's just one more thing, it's an extra level of reporting, et cetera, but I will tell you, this has come in handy like you wouldn't believe. Us having this on file on your behalf has been extraordinarily helpful with a number of audits and reviews and inquiries from regulators and from Lincoln. I remember about a year and a half ago, the SEC came to us for several advisors when they were doing their audit at Lincoln, and they wanted this kind of information. And the fact our process was something that eliminated the discussion on this for a whole lot of advisors. And it wasn't that case with a lot of people within the Lincoln system. So please, we will be sending a follow-up to this call, and I'll include a note from Judy on this, but please respond to her requests and get this stuff in. I mean, it is to your benefit to have this documented and on file. The third thing I had here is Wealth Management Forum. So Wealth Management Forum is coming up next month. I looked at the agenda. I cannot attend this year, but it does look like a good agenda. I've been promised some what they call scholarship money, so it's a way to help pay for your travel and hotel, etc. What I'd like you to do, anyone that has interest, would you please let me know, and I'd be more than happy to get this up and running, or to make sure that we get the best deal for you possible. Their normal policy on this is kind of restricted, but I have been able to take care of that and get it to be much more inclusive for people in the past. So if you have interest, just let me know, and I'll be glad to talk to Lincoln and try to get the best deal for you possible. And then last but not least, I've got the continuity plans that I did, that I rolled out last month. And I just, I've only received 2 of those back. Now, it's everyone's, decision on their own, like any other planning you do for yourself. I would just ask all of you to try and, take a hard look at that and give me a call if you have questions. But, remember that this isn't like you're selling your business to us. This is simply something to have on the books in case something happens to you that's unexpected, so death or disability. And a couple of things to remember about that. First of all, you can't do these things. You can't put these agreements in place after you die. These agreements have to be in place, in force, prior to. And especially the way we've done this, we did it on purpose so that we can include both your commission business and your fee-based business. And so as a result, we've got to make sure that these things are in place before something happens. And so for everyone, I would just encourage you to take a hard look at it. This is a very unusual thing we're doing here. I just came from a conference that it was all about mergers, acquisitions, buyers and sellers in our business, you name it. The custodians are there, the heads of broker-dealers, and the head of our custodian, Mark Diversion, was there. There's a lot of people in the industry that know what's going on in the way of advisor succession and continuity, and none of them knew of another OSJ like ours that was doing this. This is a very unique opportunity for you. The other thing is that we're not limiting it to any particular business or any particular size of practice. We're opening this up to everyone. So again, I would just encourage everybody, take a hard look, and please give me a call. Let me know if you've got any questions about the agreement. Feel free to have your attorney look at it. Feel free to have and certainly discuss it with your beneficiaries. But I would encourage all of you to act on this, so you at least have something in place so your business survives, and so there is an organized way to have your business bought out and paid to your beneficiaries. That's all I've really got. Has anybody got any questions about the stuff that I've gone over, or comments, other issues that you want to discuss? All right, I'll take that as clear as a bell, right? So, okay, so now what I'm going to do, I'm going to introduce Ted. And first of all, I mentioned to you that I saw this presentation a few months ago. I was invited by another firm similar to ours to go out and kind of see how they run some of their meetings, and they happen to have a representative from Vanguard there making the presentation that you're about to see. And I have to tell you, I was really impressed by it. And it seems to be incredibly timely to me because I know there's a lot of discussion about fees and fee compression and things of that nature, which almost always really, we act like it's about cost, but it's almost always about value. Because if you're providing value to your clients, they rarely push back on cost, especially for our firm. I'm so proud of the way you guys all do your business. All of you are, our average fee is somewhere around 85 basis points, I think. You know, that means that, and that's one of the reasons, because we have a fairly high average account size. So that drives the average fee down. But what it also means is that no one is overcharging for anything they do in our firm. There's no two ways about that. But I do think sometimes we struggle with getting the clients to understand where the value is. So I think what we're going to hear today from Ted is, it comes from some research that Vanguard has done, and of course, you know, their interaction with both clients and advisors. I think it's going to be very powerful and helpful to you. So with no further ado, I'll introduce Ted Wilson.
All right, and thank you for that background there, John. So, hi everyone, I'm Ted Wilson. I'm a part of Vanguard Financial Advisory Services. As John mentioned, we've been going back and forth for the past few months trying to get this call set up. So thank you, and both Stephanie, for getting this opportunity up and running, and I'm happy to be here. A little background on me: I've been with Vanguard for the past 3 years. The majority of that time, going 2 years and change, has been spent with financial advisors across the broker-dealer, bank, RIA, trust, institutional, every venue that advice is offered. We've kind of come across them and working to implement some of the Advisors Alpha concepts we'll go over today, as well as our products, web tools, and solutions to kind of aid in that process. So I was thinking, you know, this is going to be pretty similar to what John saw. I added a few slides from our evolution of advice just to kind of touch on the landscape of the industry first, and then go into our Advisors Alpha, and hopefully it'll be quick so we can get some question and answer session in at the end. And if we even have any other free time, I'll show you some tools on the website, just because I did cut out some of the graphs and images here. But how does that sound, everyone? And I will take no answer as a good sign here. So to kick it off here, you know, keeping pace in the industry right now seems like a lot of work. If you've been in the industry for, we used to say 5, 10, 15 years, you'd see changes. Now we can even say probably 1 year after the fiduciary changes in the broker-dealer channel here. Traditionally, from 1970 to 1990, you can see what advice was made of. It was commission-based trading individual securities. During that time period, there was also a transition into the popularity of mutual funds and identifying star managers who you would see out of Fidelity and some other active shops, and even Vanguard started as an active shop back in the 70s. That transition in 2000, 2010, and outperformance and fee-based is more introduced in a still a smaller manner compared to the transaction-based advisor industry that it was used to. It was a concept that was starting to grow a little more, also with the popularity of some ETFs coming into the marketplace and indexing gaining a little ground. From that 2010 to 2015 period is where fee-based really picked up some traction. ETFs started to gain assets. Index products and costs became more of a focus to clients. And it leads us to where we are now, where technology has really taken a predominant focus. And, you know, it's a lot of different factors come in. A higher awareness of the cost, as shown by those index products from clients. Information is everywhere. Clients have access to good and bad information, whether just going to Morningstar or reading articles on the website. And, you know, there's a large demographic shift as well. So baby boomer clients have different needs now. Women control more wealth, and millennials have new expectations, which kind of goes in tandem with the technology advances, which change which ways clients can get access to advice. So distinguishing your value from other types of advice is a conversation that we have a lot. And it's because there's so many different options in advice. Vanguard believes in advice as a whole, not in one particular type, whether it be a target date fund, a robo solution, or a full traditional financial advisor such as yourself. This slide really highlights that spectrum. So all-in-one funds, target date funds. These are going to be for the typical client who wants to do it on their own. They're just going to set it and forget it. The evolution to some of the online tools now also gives the clients the abilities to plug in some metrics, see a report on risk and return, and offer some sort of advice guidance on that perspective. Moving down the spectrum is the full digital advice. So there's discretionary and non-discretionary. Firms such as GemStep can allow you to, say, fill out investor questionnaire, and it's going to give you an output that will highlight maybe a few suggested ETFs for you to invest in and what percent. The next side would be discretionary, where it actually will go ahead and invest it with you. You still lose that human interaction on both of these solutions. It's going to be less personalized to their needs, but it's, another step in the evolution of advice. And, one of the more recent, probably I would say in the past 3 years, you've seen a lot of movement towards this space, and it would be our one example is our personal advisory services, which is that hybrid offering, combining some of that digital advice as well as maybe an ongoing advisor relationship, depending on the firm, whether it be virtual or in person. But what it still comes down to is that there is a market for traditional financial advisors. The full service, holistic planning, face-to-face interaction where the client, the client's family, their needs and their situation is still as relevant as it has ever been in the history of the industry here. So what we see is there's a few ways that you can kind of differentiate yourself from either robo-advice or falling into that trap. And if you look at this, in that gray box is where you want to kind of get away from. So distinguishing yourself from robo-advice would be, focusing on services. So you don't want to be investment management only. We see a lot of advisors who still consider themselves a portfolio advisor and focus only on the wealth management from that perspective of trying to outperform. It's falling behind and being subject to becoming a commodity and outsourced by, say, a robo-type solution. And even if it's only primarily investment management, you're still on the edge there. But by adopting additional services, whether it be estate planning, having a heavier tax focus, bringing in insurance into the picture, and just getting closer to that upper right-hand corner where you're a comprehensive planning and wealth management team, that is how you're going to become well defended against the other options that are starting to come out here in the industry. And it's really focusing on those strong relationships. And what I'll dive into after this is our Advisors Alpha concept. So this is really where you can put a value to what you're adding for your client. And it gives you a few tools in your toolkit to lean on and leverage when you're having those discussions with clients, if it ever does come up. At 85 basis points on average, I would say you're ahead of a lot of the industry. We still see a lot of people hover around that 1% mark, but really what you're doing is you're saying, say, over Vanguard service at 30 basis points, this is where your 55 basis points comes into play right here, and it's in these next slides that we're going to dive into. So since coming out with our advisors, well, actually, before diving in, does anyone have any questions or any comments on that evolution of advice? And you can also chat if I'm speaking, if you want to get a question out there as well. All right, so I'll move on here then. So what this is going to be just an overview showing where advice is about 3%. So since coming out with the concept in 2001, we've had to continue to research on the value that advisors bring to clients. And in the most recent study, we believe it's about 3%. We know that investment advice comes to the need to quantify the value added, and it can sometimes be very difficult to do for your clients. So developing a strong value proposition and defining what you're adding to clients is key in the industry that we are in right now. When talking to your clients, liken the service that you provide to that of an accountant or a painter. So as we went through some of those earlier slides where it shows the evolution of maybe a one fund solution versus hybrid, robo, you can think of it as what happened in the tax industry when, say, H&R Block came and had brick and mortar locations and then put their full services online. People still need a full service accountant for more complex topics. But for some, say millennial who's just getting their first job out of college, maybe going online and H&R Block is going to be the solution for them. We see that didn't run the accounting industry or any accountants completely out of business. It just made them really focus on where their priorities need to be. And a few that we've highlighted are advisor guidance, timely communication, and proactive advisor who initiates the discussions with their clients and stays involved with their life and knows what their needs are. So the three sections of the Advisors Alpha framework are portfolio construction, wealth management, and behavioral coaching. So in the portfolio construction, we chalk it up to be about 120 basis points. And we're going to dive into each of these subcategories in them in a moment. Wealth management, we see that at about 105 basis points, and advisor guidance being the biggest component at 150 basis points. So all in, give or take, depending on the client situation, it's about 3% of total added value. So first, we'll start off with the asset allocation. So as far as asset allocation, we like to know the importance, of where the stock to bond ratios need to be, because each client's time horizon and risk tolerance and goals are highly individualized and variable. It's hard to put a specific number to this. It would be difficult to quantify and extrapolate a value of helping a client who's, say, been sitting in cash for a number of years and trying to get back into the market, or vice versa, where a client's been 100% invested in their company's stock and is trying to divest into a balanced portfolio. Over the long term, we do see that just being in the appropriate asset allocation is going to be one of the most important figures in reaching the client's long-term goals, and also the key determinant in the performance. So about 90% of returns come from, say, purely that asset allocation. Another, say, 7% might come from a style tilt. 2% maybe from what time you eventually get in the market, as long as it's over the longer term. And then 1% possibly can come down to any manager or product selection. So just making sure that you get your client into the appropriate asset allocation is going to be a key part of this framework and what you can set yourself apart from. And it's just making sure that you don't let the client, say, be over-invested in stock or too heavily in conservative in bonds so you can meet their goals. The next part of this portfolio construction process would be cost-effective implementation. So what we deem this as is really taking a look at the average expense ratio for, say, either an all-in bond portfolio or an all-in stock portfolio. So, the last note we have is about 47 basis points would be the expected cost for an all bond portfolio, and 61 for an all stock. Balancing that out to a 60-40 portfolio, you could probably save about 40 basis points annually by moving to either lower cost active products or using ETFs or index funds in that space. So that alone, I've seen clients who come to an advisor with portfolios who are over 1%. Vanguard has model portfolios and a framework I might have a chance to show you at the end of the call here, which gives you a guideline, but those go down as low as 7 to 10 basis points now. So that alone can make up that fee that you're charging in itself. So being cost effective in implementation, you take gross returns, take out costs like it says in this box, and that's net returns. The less they're paying for their products that they're investing in, the more they're keeping. And on the fee-based side, the more they're keeping, the more their assets grow, hence the more your fee will also grow over time with the client. So it really aligns both of you and the client's needs over the long term. Next in this portfolio construction process would be asset location. So making sure you're being conscious of what's going in taxable and what's going into tax advantaged accounts. So a big thing that we would see, and we work with advisors in converting over, is, say, getting active equity out of the taxable accounts and getting it into a tax sheltered vehicle. And same with, say, any fixed income products, unless it's on the municipal side. The reason being is if you can have, say, an index product in your taxable account and you can hold it for the longer term, there'll be a minimal income paid off. Say right now, I think the S&P is yielding about 2%, which would be a taxable burden there. But over the long term, you could be taxed at a lower rate, capital gains, anywhere from that 15 to 20% mark, instead of going as high as just a hair under 40% if you're paying short-term capital gains or just paying income from the bond funds. So putting a focus on where you're holding specific assets is going to be another key determinant in adding some additional value to your clients. And the last in this portfolio construction, this is a topic that I don't know if it'll ever die on your side. I'm sure a number of you have clients who refuse to listen to the total return approach and are still looking for portfolios that are going to yield them 5%. Given the current interest rate environment, 5% isn't a realistic figure. 4% might not be a realistic figure moving forward. So what we see is a huge advantage is if you can coach your clients into taking a view as a total return. So you don't have to have the high yield corporate overweights, which end up being very correlated to equity markets in a downturn. You don't have to put a heavy tilt to preferred, but instead you're going to get them in that appropriate asset allocation like we started off with, and then use a mix of capital gains and income from the portfolio to meet their needs. So we see the total return approach having greater, some significant effect, but it's another one that's just too unique to the investor to quantify on a hard number basis. So I'll pause here after portfolio construction. I don't have any questions around any of those topics. All right, I'll take that as time to move on here. So the next section in wealth management, this one is simple and it's very easy to do. It's rebalancing and making sure that you can kind of, once again, it's all going to come back to coaching the client, but say when the market has been on a long-term rally, that you can keep them thinking that rebalancing is not there to enhance performance, but to reduce risk. Studies have shown that if you say in a period where, even say from 2008, if you let the client's portfolio after that drift from a 60-40 mix, the risk profile on it almost ends up being more like an 80-20 portfolio. So by rebalancing every year, you're going to be able to bring that risk back in line to match up with the client's long-term goals and needs and objectives. After that is a spending strategy and withdrawal order. So there would typically be a slide after this. It gets a little more complicated, so I'll get that out to everyone after the call here on how you can approach the spending on the portfolios. So we view that the number one thing to do is make sure you're spending from the RMDs. So take out the required minimum distribution first. Any additional income they need after that, we see, and we've run numerous simulations where actually going to the taxable accounts first is going to be the most beneficial. A lot of clients, when I was on the personal investor side of the business, would call in and want to take from, say, their Roth IRA first because they don't have to pay taxes on it. But the approach that we looked at it is long-term total wealth. So by allowing the assets in either, say, the Roth or the traditional IRA type vehicles to continue to grow without being taxed, in the end, it's going to end with a higher value for the client than if they were to draw on those first and then go to the tax accounts. So we have a lot of research. We have a new white paper from assets to income, which you could take a look at, that goes pretty in depth into various different ideas on how you can approach spending strategies with your clients and give you a few tools you can go into those meetings and position with your clients.
Hey, Ted, this is John. First of all, would definitely be interested in seeing that tool or anything you can share on this subject. This has been coming up a lot. And one of the issues that I've seen, I've looked at several of these tools, and oftentimes what you see is they don't really build the tax code into their systems very well. So in other words, there's still a lot of kind of clumsy math you have to do in the background in order to choose the right buckets to do these withdrawals. Do any of these tools you guys have, are they building in tax consequences to the results that they provide?
So as far as a real tool where you can input the client's situation, we have a hypothetical illustrator, excuse me, which can draw historically on how the client could spend down. That you can input different tax scenarios. So you can put the client's normal income tax rates and then capital gains tax rates, and then break it out from that perspective. What our framework is more aligned with is kind of how they can set goals on how they should spend, instead of say, I need 4% every year it would be around taking that 4% number and adjusting it for inflation and continuing to grow that way and adding buffer zones. But I can try and show you at the end here. I think we'll have some extra time where I'll point out the tool. And if anyone hasn't registered for the site, I would suggest registering for it, because we do have some pretty useful tools for, whether it be just drawing out illustrations or getting a snapshot of the portfolio for clients. But it's going to always be a difficult one, just because clients want to lean towards simplicity. What seems logical to them is, I don't want to pay tax on this first. But I'll follow up with you, John, just so you have some resources to hand out to your advisors.
That sounds great. Thank you.
So after that, this is the last and most important component. So we put 150 basis points at advisor guidance and behavioral coaching. So this is really where you can differentiate yourself from any of those online or robo services. If you come to Vanguard's personal advisory services, you're going to have maybe one phone call a year with your financial advisor. If you're calling during a time of market stress, everyone and their mother is going to be calling Vanguard at that time, and it may be very difficult for them to get in touch. What we think is important is being able to connect with that client and say, do you remember in 2008 when I told you not to sell out, and see where we are now, 9 years later. Having more of those moments and being able to make sure that they are staying aligned with their long-term goals is going to be the most important differentiator that you can add as an advisor. So a lot of it comes down to little tiny details that you can't just put on the statement at one time and show, here's the 3% I added. And we encourage advisors not to look for funds and try and prove, hey, I outperformed the S&P 500 by 300 basis points this year. But look and coach and be there for the client as an emotional circuit breaker, as it says right here on the slide, to make sure that, right now, after we've had a number of years of a market rally, they say, I think it's time for me to up my equity holdings. I want to go 80-20. The 50-50 thing hasn't gotten me the returns I wanted. And being able to cite previous historical times and what happens in a market correction and the benefit of staying in their appropriate asset allocation. So the behavioral coaching side of it is really where you can differentiate yourself and over the long term with your clients, and maintaining that key relationship so they don't question that value that you're adding. And then you can point to specific times where you were able to help and aid the client through those scenarios. So after you look at it, Advisors Alpha framework is really a win-win for you and your clients. For the clients, it's a potential increased net return, protection against undue risk, and a peace of mind and guidance. For you, if you think about it, you're spending less time trying to outperform the market, which means more time with your clients or prospecting to grow your book of business. Once you have those better relationships, we've seen advisors that have implemented these processes into their day-to-day practice. They're having a higher retention of clients, and they're even, using some of the other material we put out there, like retaining heirs, and it gives them more time to connect on a different level that they hadn't previously done. And it just leads to practice growth, because you'll have higher client balances, increased revenue, greater profitability, and probably more client referrals from implementing this framework. What it really comes down to at the end of the day is control what you can control, and those are things such as cost. So make sure you're using that cost effective implementation. Make sure you're rebalancing that portfolio. Don't avoid difficult conversations with your client just because you don't want to go through the back and forth and give in and let them move to an asset allocation that isn't appropriate. And make sure that you're that emotional circuit breaker. So taking that action plan and just controlling what you can control. You can't control the market, so why put all of your dice or all your money and all your cards in for trying to outperform it when that's something you can't take ownership of? But find areas where you can control your success and own those. So that is just the quick presentation here. I did cut out a few slides, so it's more resources I'll get to John just for the sake of time today. But what questions do you guys have?
Hey, Ted, this is John again. One of the things, first of all, the behavioral coaching, I think we've always kind of talked about this being our probably one of the most valuable things we bring to the table, and it's interesting how you guys quantified that. And you know, I've always thought it'd be nice if there was a way to do that, you know, to put a real value on it. But you know, when you look at what happened, like in the economic meltdown back in 08, 09, that period, gosh, you know, do you have any data from that, maybe like that period of time, that shows, you know, the people that sat tight and the ones that didn't, you know, what the end result was?
Yeah, so that all kind of fell into some of the additional slides here that we cropped. But let me see, I could probably pull those up. But the 150 basis points, the study that we actually used for this was, luckily for Vanguard, we have clients on the personal investor side outside of their 401ks investing. We have clients who have a robo-advisor. Our biggest business unit is the business unit I'm a part of in intermediaries, so using other financial advisors across the country to help serve their clients. And then we have a large 401k business. So what they did was they actually took a look at our 401k clients, and they saw what their initial investment is going to be, which would be a target date product. And they tracked everyone who deviated from their target date fund. And the average investor who deviated from the target date fund underperformed that product by 150 basis points.
Yeah, you know,
a lot of trailing return or chasing return.
It's interesting because I have heard, you know, a number of people that really focus on that 401k market either suggest or require that everyone on an annual basis immediately goes into the target date funds, and then they have to basically, you know, choose to get out.
Yeah.
And I think a lot of it is exactly what you're saying there, is it builds some discipline into the process that a lot of people just don't have. And the 401k oftentimes is exactly where people are making their own choices. So, you know, that's automatic discipline if you're in those target date funds, but it's the same kind of discipline that advisors bring to the table when they keep clients in their allocations with proper rebalancing. Exactly.
So what we look at is the target date fund, you know, actually encompasses a number of the features and traits we were looking at. So low cost implementation, rebalancing, asset allocation. It doesn't handle the asset location, and most importantly, it doesn't handle the behavioral coaching. So you still will find people who are in the 401ks using that target date fund will want to sell out in market downturns. So that is where, you know, an extra 150, 200 basis points can come from, say, using a target date product or a robo-advisor that can't advise on their 401k. And it's really easy to say, hey, 30 basis points for Vanguard, you're charging 85. There's 55 basis points right there. What you're doing is directly adding the value right away from that perspective. But I could use this time, because we have a few more minutes, and show you our advisor's website. And we actually have client-approved one-pagers that would tie into this. So this is our advisor's homepage. So it's a dedicated resource for financial advisors. We'll have comprehensive tools here. So the analytics tool is the one John and I spoke about a moment ago. But where people find the most value is in our resources, and then under advisor support, literature, and forms. So we have a mix of client-approved research and also research just for yourself. And right here under filter, we have behavioral coaching as its own client-approved topic. And then all you have to do is hit apply. And we have a number of one-pagers here. And to go along with the one you were asking about, John, is, let me see, I think it's going to be this. They changed the names on us recently. Sorry, this is the reaching for yield. track it down and send it to you. We do have a slide and a one-pager that you can use with your clients that shows what happens when someone sold out in 2008 towards the bottom, if someone was in a 50-50 balanced product or if someone was 100% stock. So it shows what that effect would have been over the long-term wealth for the client.
Thank you. One other comment I'll make is on rebalancing. I feel like this is an opportunity for us. I know there's two different camps, of course, in our firm, and some of you do both these things, but there are times when you're building your own portfolios for clients, and there are other times when you're outsourcing that either to CAMs or to a TAMP or something of that nature. But even with those of you that are, certainly if you're doing your own asset management, you ought to be rebalancing on an annual basis. It is a huge opportunity, and it's also a risk not to. I remember an advisor a few years ago that one of the ways that he was getting accounts was he was walking into client meetings or prospective client meetings and saying, do you have an investment policy statement? And if they did, he would ask to see the statement and then match it against portfolios. And in virtually every instance, they were outside the parameters of that IPS. And that's just from not staying on top of your allocations and doing the proper rebalancing and updating those agreements. So, certainly if you're doing your own, there's a huge opportunity for you here. Number one, to demonstrate your value, but also to insulate that client from having to do a little bit more behavioral coaching with them in the case of a downturn. But also if you're using TAMPs, typically what people are doing is they're using TAMPs and maybe, 2 or 3 different strategies to get the overall result you're looking for. Make sure you're rebalancing that as well. Make sure that, a runaway market isn't ruining your allocations there. So huge opportunity for everybody to just take a hard look at that rebalancing process, I think.
Right, and I'll show you one thing right here, and I agree 100%. So if we take a look, this is part of the tool I was referring to. So John, I'm going to follow up with a few items for you, and I'm going to give you the contact information for our inbound team here. So we specialize in the tools on the website and then our products and some of the research. So I'd be happy for anyone on your team who wants to come in or spend 10 to 30 minutes or even longer, depending on how in detail they want to go on how to use these tools. But here's one. So this is one of our model portfolios. This is a 60-40 portfolio to start. I'm first going to choose no reinvestment and hit apply. And I'm just doing it since 2001, so we're getting a little over 15 years of data here. And what we can look at is in 2008, an unrebalanced 60-40 portfolio lost 27% by just simply changing that rebalancing to annually. We see that drop to 20.9. So that right there, this is the difference that we're quantifying from rebalancing. Just being conscious of, even though maybe you have views that the market is going to continue to rally, you never know when it could pull back, and it's key to make sure you're rebalancing just for the risk perspective in case of that downside event.
Perfect. Thank you. Folks, any other questions for Ted while we've got him on the line?
Ted, can you hear me?
Again.
This is Ryan Weber. Hey, I had a quick question just in regards to the indexing. Obviously, it's been very favorable over the last several years, and some of the articles I've been reading about are just some of the hidden costs, and I wonder if you have any sort of recent research on this to kind of discuss the perils of index investing when it comes to corporate governance and, the autopilot, as you said, set it and forget it. But, when it gets down to the underlying expenses of these companies that are doing buyback programs, and if an index fund is a majority shareholder, it's like a passive vote just for an automatic yes. And so, yeah, your expense ratio might be low, but as Bogle always said, 1 or 2% increase in cost over a 30-year period can be pretty substantial. Well, in some of these cases, and I've read articles from pension magazines and stuff showing that some of these increased costs can be upwards of 4%. So yeah, you have a low expense ratio, but by a passive vote in the boardroom, you're not really representing the shareholders of the 500 companies that are in your index fund. Do you have any comments on that at all?
Yeah, so this topic's been coming up quite a bit, is the indexing getting too big? One side of it that we hear a lot is someone saying price discovery, but indexing is really still only making up barely, if 5% of daily trading in the equity and fixed income markets right now. But on the other side is the corporate boards. So we actually are building out our team, and you probably see in the news that State Street and BlackRock are becoming more and more involved in that corporate governance. So as of right now, we're going through a proxy vote, which is even coming up on some of those topics. And we're getting a new board. We have a new CEO coming in. So we're growing our team because we realized that with the scale that we've gained over the past few years, that we're going to have a more important stake in those companies. But the way we look at it is we aren't experts in every single company's industry and field, and to have people to cover all of them would just add astronomical headcount and cost to the company. So what we do is we have a direct team that kind of will engage with board of directors where we are those key stakeholders and look to work with them to get long-term effective solutions that are going to be beneficial to all the shareholders. So we have heard that. We have a lot of articles. That's another thing I'll put on my to-do list. I'll send out one from our CEO and then just another blog that we have on it that addresses some of those concerns.
And then what kind of a head count do you guys have where you're actually participating in the boardroom discussions with these companies?
Oh, that's a good question right now. I think the team is at about 15 right now, but I'd have to double check on that for you. I'm not
how much money do you guys have, just per se, in the index fund?
So on the index side, we are probably about 2.5 to 3 trillion now.
Wow, that's quite a bit of money for that many few heads. Thank you for your time today. It's a great presentation. So,
thanks, Ryan.
Okay, anybody else? Well, Ted, thank you. Well, first of all, appreciate the preparation and the presentation today. And then Stephanie and I will follow up with you, and we'll be getting some follow-up materials to send out to everybody, and see if we can make the most out of the tools that you have there. It sounds like something that we can take real advantage of. So thank you so much. Appreciate it.
Well, thank you too for the opportunity here. And then I look forward to following up with you, John, and getting those resources over for everyone. And then I'll give contact information in case there's any questions they have.
Perfect. Folks, we're on schedule here. Any questions for me? All right. Listen, thanks so much. We will be having another one of these calls. We'll send you a reminder. I don't have the date in front of me right now, but we'll get it back. We'll get it out to you. And be watching your emails. We'll be sending you some follow-ups from today's meeting as well. So thanks so much for your time, and we'll do this again next month. Take care.
All right. Thank you. Bye.
Bye-bye. Bye-bye.